Good morning, good morning, good morning. It is Monday, the 7th of April. This is the morning blast with myself and Mr. Michael Brown. Some are already calling it Black Monday. I will leave judgment of that to the wiser people in the room. But before we get on with today's morning blast, I'll get the legals out of the way. So as usual, nothing discussed in this space. This session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, joins PIQ or PIQ Suite, or indeed the hosts, which, as you know by now, is myself, Mr. Ryan Paisley, and of course, Mr. Michael Brown. Good morning to you, Mr. Michael Brown.
Hello, Ryan. Hello, everyone. I won't say good morning because, to be completely honest, it isn't.
Well, yeah, you could take that view, I suppose.
It's horrible.
Look, the sun is shining. There's a bit of red on the screen, but we're all still here.
Well, yeah, we're still here. Our portfolios aren't, but we are still here nonetheless.
Yep, very true, very true.
Oh,
Go on then.
dear.
What's been occurring?
Well,
Why are the markets down?
Indeed, unless you've been living on Mars for the last couple of days, you'll know that last Wednesday, a very orange man in the United States decided to announce so-called reciprocal tariffs, and ever since, it's really been one-way traffic lower for financial markets. That very much continued towards the back end of last week, with the S&P ending Friday down by 6%, its worst day since 2020, and the Nasdaq ending the day over 6% lower, 6.1% lower, down into a bear market, having fallen 20% from the record high. That selling pressure has continued, and those losses have extended into the fresh trading week. As I speak, the S&P future down another 5% in the first 9 hours of the new trading week. The Nasdaq future down by 5.5% this morning as well. Of course, do bear in mind that for CME equity futures outside of the cash session, there is a circuit breaker which triggers a 15-minute halt at a 7% decline. So do, of course, just bear that in mind in case you are out there with any exposures today. That softness, unsurprisingly, has spread across the board. We've seen chunky losses in Asia. The Hang Seng was down by about 12%, although there is a bit of a catch-up effect with the index having been closed on Friday. The Nikkei, that's fallen into a bear market, and Europe is just an absolute bloodbath. This morning, the FTSE down by 3%, the CAC 40 in France down by about 7%, and the DAX in Germany down by about 10%. All of this comes as market participants really brace for impact in terms of the economic shock that these tariffs are likely to cause. The US economy, if these tariffs remain in place, seems like it is barreling rapidly towards not only a recession, but also much higher inflation, with CPI likely to get somewhere between 4 and 5% in the coming quarters. The other issues for financial markets are, firstly, that other countries are coming out swinging with tariffs of their own. We heard on Friday that China, having been hit with a tariff of 34% from the United States last Wednesday, they have announced a tariff of 34% on all US goods imports effective from the 10th of April, while also imposing controls on the exports of rare earth related items, and having filed a lawsuit with the WTO over the supposed reciprocal tariffs that the United States has involved. As if that wasn't bad enough, we also have the EU talking about reciprocal tariffs of their own, as well as a whole host of other nations, although it is just worth bearing in mind that some, including Vietnam, which is the obvious one that springs to mind, are looking to try and cut a deal with Trump, though the US's largest trading partners are very much in the camp of retaliating rather than rolling over at this moment in time. The other issues for financial markets are that nobody seems to be riding to the rescue, and nobody seems to be making any kind of pivot just yet. From the monetary side of things, we heard from Fed Chair Jerome Powell on Friday, who noted that the tariffs are likely to cause higher inflation and slower growth, and that it is the Fed's obligation to keep long-term inflation expectations well anchored. To translate that from central bank speak into something akin to English, that is Powell saying, do not expect any rate cuts anytime soon. He then went on to say that the Fed do not need to be in a hurry and that the economy is still in a good place despite ongoing uncertainty. Yes, the S&P was 5% higher when he made those remarks, but to me it's pretty clear that the strike price for the Fed put is much lower than where we trade at the moment, and the bar to deliver any sort of monetary easing is quite a high one given the Fed's concerns about rising inflation. There also doesn't look like there's going to be any kind of pivot anytime soon from the White House either. We had a whole host of senior Trump administration officials on the weekend media rounds in the United States. Scott Bessent, the Treasury Secretary, was saying that he doesn't believe the tariffs imposed run the risk of causing a recession. He was saying that the market consistently underestimates Trump and that occasionally you get these short-term market reactions. Clearly, the Department of the Treasury not overly concerned about the downside that we've seen in the equity space. We also saw White House advisor, CEA chair, Kevin Hassett, singing from a very similar hymn sheet, saying that he does not see the tariffs having a significant impact on the US consumer. And we also heard from Commerce Secretary Howard Lutnick, who noted that the tariffs due to go into place on April the 9th, which is of course Wednesday, will not be postponed, and that those tariffs could be in place for days and weeks. Although it is worth bearing in mind that that question was a little bit loaded, the overall message from Lutnick was that the US will not be backing down on these tariffs anytime soon. We then heard from the president himself on his way back from Mar-a-Lago yesterday evening. Incidentally, he was in Mar-a-Lago for a golf tournament, which of course he won. Nevertheless, he was saying to journalists on Air Force One that he cannot say what will happen next in markets, that they are not trying to engineer a sell-off, and that the US will not make any deals unless trade deficits are solved. I think this latter point is very, very important because it suggests that Trump is not necessarily looking for other countries to cut their tariffs to zero. He is instead looking to balance out trade deficits and surplus, which, it goes without saying, is much, much harder to do than it is to just take tariffs out of the way and then we go back to how we were. So I think it's a combination this morning of markets panicking when you wake up and you're running risk and you see the market down 6%. Naturally, you want to get out of Dodge pretty quickly. We also got a market that is pricing significant downside growth risks, if not recession risks, in the United States. And of course, where the US economy goes, the rest of the world will probably follow very, very quickly. And it is also a market that is looking around going, who or what can solve this issue? And the answer to that right now is that no one seems to be riding into the rescue anytime soon. And that is why we've seen this significant equity downside. And we've also obviously seen demand for safe havens elsewhere. 2-year Treasury yields, for example, down by about 19 basis points as I speak. The 10-year Treasury down by about 10 basis points. We've also seen decent inflows into both the Swissy and the yen as well, which remain the havens of choice in the FX space. The dollar, unsurprisingly, a little bit softer, largely due to the market seeing the greenback as the single most exposed asset to the nonsense that Trump is playing at, and unsurprisingly not wanting to hold the dollar too much at the moment. In terms of other bits and bobs that have kind of spillover effects from the market, let's call it turmoil, because it basically is at this moment in time.
Drink.
Wait for that. Buy the dip when that's on CNBC. Not investment advice, of course. There are a couple of things worth noting. The first is that a whole host of listings and IPOs have been shelved as a result of the downside that we've seen in markets over the last 3 sessions. The Wall Street Journal reporting on Friday that 4 IPOs were put on hold at the back end of last week, including buy now, pay later firm Klarna, ticketing firm StubHub, and broker eToro. All of them have decided that they are going to wait for market conditions to improve before moving forwards with that listing. And also, just in terms of stimulus, we have seen some degree of response from China. Bloomberg ran some reporting this morning, which I will admit had some rather misleading headlines. The headline noted, China discusses front-loading stimulus to counter a tariff hit. The various lawmakers in China have debated how they can boost consumption and support exports. There are two massive caveats with this headline, though, and probably the reason it didn't engineer a huge bounce in risk. The first is that the majority of these measures were already planned before Trump made the reciprocal tariff announcement. They're not talking about more measures, they're just talking about changing or potentially changing the implementation date. And more importantly, the officials at those meetings decided that for the time being, there are no changes required to those measures. So China sort of talking about stimulus, but not actually delivering it. We have, though, seen the Central Huijin organization, which is a sovereign fund in China. They have carried out what have been euphemistically called market stability operations overnight. They have been buying a whole host of ETFs and vowed to further increase their ETF holdings as well. So just one to keep on the radar there.
Basically, the Chinese. I don't know what the Chinese is for. The Mandarin is for PPT, but it's basically their version of the plunge protection team.
Yes, they call it the national team.
Oh, there you go.
Like the England football team, but the China national team have been getting involved. And last, but by no means least, well, I'll just mention a few other market moves. Obviously, we saw a big move lower in both the Aussie and the Kiwi on Friday, and that's continued this morning. No surprise, high beta FX just taking an absolute battering, and also the impact of China there as well. Crude has continued to crumble. WTI down 7.5% on Friday. We trade below $60 a barrel this morning, with Brent and WTI off 4% apiece. Interestingly, the losses seen in WTI on both Thursday and Friday were about 14%, and that's the worst two-session run since March of 2022, when we saw that big reversal after the spike higher at the beginning of war in Ukraine. And last, but by no means least, I feel like I should probably mention the jobs data that we had out of the US on
Oh yeah.
Friday. It was possibly the least impactful and least memorable jobs report that we've had, well, certainly that I can think of in the last decade or so. But it was better than expected. Headline non-farm payrolls rose 228,000 in March, well above the forecast range and median consensus of 140,000. Unemployment did tick higher to 4.2%, but that was due to the participation rate also rising to 62.5%, while earnings growth remained unchanged at 0.3% on a month-on-month basis. The takeaway from the jobs data is very simply that in March, the US labour market up until the 12th of March was very, very solid, and actually more solid than expected. It's just a shame that 3 weeks later, the bloke in the White House decided to take a wrecking ball to the entire economy, really, and to the stock market as well. I will leave things there for the moment, and we'll get into the week ahead after your little rundown, Ryan.
Cool. Thank you very much, Mr. Michael Brown. But just a couple of things. Firstly, we did call the non-insequential NFP figure. We did say that on the show on Thursday and Friday, I believe, saying, look, we'll be very honest with everything that's going on. No one's really going to care about NFP. Was I right in thinking as well that government jobs actually increased? Do I remember seeing that headline?
They did, yes. That may have come from me. Actually, government employment rose by 18,000 in the month of March, although I would just caveat that that was all state and local government. Federal employment did fall by 1,000, but still,
Right.
if Musk wants to trim government, he hasn't done a very good job of it.
No, exactly the point I was trying to make. Just another thing as well before I crack on with the splendid overnight news roundup, courtesy of Zach, as always, on the slopes, but also giving us the headlines that matter. One thing, I did tweet this over the weekend. Anyone you see claiming these markets are trading like the global financial crisis is a fraud. These markets
Oh,
are not
100%.
trading. These markets are not trading anything like what we saw in the global financial crisis. Trust me, I was there, and it was scary as fuck. We were like, you would have positions, and you were genuinely waking up concerned that not that your positions would be red, your clearinghouse would be bankrupt. These are not the same conditions. Anyone claiming that they are quite clearly was never around during that time. So just something to bear in mind. This is very orderly.
Mm.
Yes, it looks a bit scary when you look at the chart, but it's trading every tick. It's very orderly. So just want to throw that one out there.
Yeah,
But
actually,
anyway,
on that, sorry, I'm going to interrupt
go
you.
on.
We will move on momentarily.
Yeah.
Two things from me. Lastly, one is I was just discussing this very point with one of the guys at Reuters. What we've seen up to now has kind of been the first order. Holy shit, this is all worse than we expected. Panic, let's get out, but in
Yeah,
orderly fashion.
yeah,
What we haven't yet really had to start worrying about is the second order effects of all of that. And what I mean is, firstly, when participants get away from going, okay, I've now got a book that I'm somewhat happier with in terms of how I'm positioned, but now how much lower do I need to revise my economic growth expectations or earnings expectations or whatever it may be appropriate
yeah,
to what you're trading. Also, on that note, we haven't yet really had to consider any of the potential liquidity or illiquidity effects that tumultuous times in markets like this can cause, particularly if we see a rush among market participants to raise funds in order to pay margin calls elsewhere. And that forced selling, that's something else just worth bearing in mind.
yeah.
And lastly, I will end on a bit of good news. A trading halt has been imposed on my puns until market conditions improve.
Oh,
Sadly, so
fantastic. That is the best news that we could have had all day. So, yeah, so look, listeners, you might be doing your ass in the markets, but it's not all bad news. But anyway, let me quickly get through some these headlines from the overnight news roundup. So, obviously, Trump's weekend comments weren't great. He said Europe, quote, dying to make a deal, but insists no talk unless they pay us a lot of money, quote. Hundreds of billions have been lost to China, says Trump, who's only willing to negotiate if Beijing raises its surplus. Trump calls critics talk of a Trump put stupid, insisting tariffs are medicine for deficits. The administration backdrop now, Commerce Secretary Lutnick says, quote, no postponing tariffs remain. Treasury Secretary Bezant goes on about tariffs are necessary and many nations want to negotiate, but it will take time. Elon Musk suggests that zero tariffs on both sides, but White House sees them as national emergency measures, not bargaining chips. Global trade fallout. China, furious about the new tariffs, Beijing says it'll take resolute matters to protect its interests. ByteDance's TikTok spin off talks have stalled after the US tariff announcement. In Europe, the EU members disagree on a response. No surprise there. Some want certain goods exempt, others want a direct blow. A final vote may not take effect until mid-May, so not, unlike the EU to be dragging their feet. French Economy Minister Lombard urges proportionate but not identical retaliation. Meanwhile, UK PM Starmer, French President Macron vow that trade wars serves no one's interests. Other worldly affairs, Canada have rolled out 25% tariff on 35.6 billion in US auto parts. Japan's PM Ishida still awaiting a call from Trump, aims for a single tariff deal. Vietnam, Thailand, and India are both treading lightly, hoping to avoid deeper confrontation or find routes to negotiation. In terms of the macroeconomic outlook, what's hitting the economy, the consumer rush. Americans are snapping up everything from TVs to Lululemon gear ahead of price hikes. Cargo flights from China cost 40% more than a month ago as everyone's trying to get the goods over before the tariffs land. It was a slight pun there, I guess. Markets and data. Goldman Sachs warn a US recession is now its base case unless new tariffs are scaled back. JP Morgan sees unstoppable volatility with estimates of billions more in equity selling by risk parity and volatility targeting funds. Asian credit markets are jittery. Eurozone borrowing costs could surge, and people are parking money in money market funds. Stimulus and response. China may ramp up domestic stimulus, possibly cutting rates, boosting consumption, and stepping in with the national team, as we've seen this morning. Japan watchers say that the 10-year JGB yield fell nearly 37 basis points this week alone, biggest drop since 1992. And BOJ mulls an extra budget to cushion tariff shocks. Some geopolitical headlines: Russia, Ukraine, high-level US-Russia talks on direct flights, both cozying up to Trump, hoping to the other fails to make peace with him. Iran, Trump's Tehran as price. I start again. Trump says Tehran likely wants a direct nuclear chat. China and Cambodia conduct joint naval drills at its expanded base that the two share. Trump's US admits that tariffs might complicate weapon supply chains. He's also contemplating new deals with the Democratic Republic of Congo for critical minerals. This would be probably a little bit of a poke in the eye to Zelensky, who's obviously trying to get a metals deal across with them. Taiwan and the US. Taiwan's NSC heads will visit Washington as China steps up war drills. And some corporate roundup. Meta, their latest Llama AI release stokes big tech regulatory fears. Rumors swirl that the White House might drop the FTC's big antitrust case. Nvidia, the Digi Times, sees potential new delays for the Blackwell chip. Seems to be an ongoing story, possibly into 2026. Foxconn, Q1 revenues soared on demand for AI gear, but warns that global politics remain a risk. Samsung seeking 3 to 5% price hikes on memory chips as customers stockpile ahead of tariffs. And finally, for me, Toyota plans more EV production in the US, Thailand, and Argentina to broaden supply chain amid tariff threats. And that's it from myself and Zach. Back to you in the studio.
Nice one. Thank you very much indeed, Ryan. In terms of the week ahead, then, I see we've got a whole host of new listeners. Usually I would sit here and recite off the economic calendar, but to be completely honest with you, I'm not entirely sure there is much point this week because I
No,
think
I
most
agree.
of the releases will matter just as little as the non farm payrolls figures that we had on Friday, given that the data really references an economic age that frankly no longer exists. In terms of what market participants will be focusing on this week, I think there are a few things to bear in mind. Of course, the first will be what comments, if any, we get from the Trump administration. Will Lutnick, Besant, Trump, Vance, whoever else gets in front of a microphone, will they continue to double down on the hawkish protectionist rhetoric and the reciprocal tariff plans, or will they show any signs of pivoting on that stance? I really would not be holding my breath for them to pivot on that anytime soon. As I wrote in my note this morning, Trump, in interviews going back 40 years, has been talking about the need for tariffs and how the US is treated unfairly. He's finally got a chance to put in place the policies he's been touting for that long. I don't think he's going to rip them up less than a week after he actually implemented them.
Well, just on this is what I found completely bizarre about the German. I can't remember who it was. The German policymaker that basically said, "Oh no, we fully expect Trump
Oh,
to
the Green
stand
Party
down."
guy,
Yeah,
Haybeck.
I was like, "That's it." I was like, You obviously don't know who Trump is." Trump,
Yeah.
if anything, will dig his heels in deeper. Just before you go on, though, just a quick one, kind of a bit of putting you on the spot slightly. What do you think the market reaction is? Should Lutnick or Besant unexpectedly step down? Because
Oh,
that
that's a good question.
either one of
Uh,
those two things happening isn't that wouldn't be that much of a surprise in my opinion, because
no,
we are
I
hearing rumors of like a fractured White House.
yeah, and again, like this, it's not my base case, but as we said last week, it did seem like Besant wasn't really in the room when the tariffs were being discussed.
Well, exactly.
My and I haven't had any time to think about this, but my gut feeling would be if Lutnick goes, the market takes that as a net positive. Frankly,
Yeah,
because he's a
I'm with
moron.
you. Yeah,
If Besant goes, the market takes that as a net negative because he is seen as a markets guy and a little
yeah.
bit more of an adult in the room. And if he's gone, then who the hell comes in? I wouldn't say, and I am biased here, of course, but Scott Besant hasn't been as stabilising influence as my doppelganger, Mr. Mnuchin. But
True.
nonetheless, he may be moderating things slightly. And I think if he was gone, then that would lead to market participants going, well, who the hell's going to replace him?
Yeah,
Um,
I'm well, bizarrely and maybe slightly concerning for you, but I'm in exactly the same camp. I think that would be the two reactions we see if either one of those decides to leave.
Yes. So yeah, worth keeping an eye on that, as you say. In terms of other things to focus on this week, obviously rhetoric from the Trump administration, as we just covered. Also worth bearing in mind the response across the globe. If we see any deals being cut, for example, countries lowering their tariffs, if the US lowers the reciprocal levy, if countries are pledging to buy more stuff from the United States, does that mean the tariffs are lowered or even removed? On the other side of that, what does China do next? Do they ramp up their retaliation? The EU, they're meant to be meeting towards the middle of this week, I believe Tuesday or Wednesday, to discuss potential retaliatory tariffs of their own. You may be able to get from my vibe here, there's a lot more questions than answers. And I think that speaks to just the broader degree of uncertainty that dominates the outlook at the moment. Also, of course, bear in mind any potential comments from policymakers on the FOMC. Again, I think a Fed put is not really something that we should be banking on right now. But it is nonetheless, of course, going to be interesting if we do get any comments from some of the big hitters at the Fed, thinking the likes of Powell, Williams, maybe even Waller at some point this week. Of course, do bear that in mind. And the other thing just to be aware of is we have come a hell of a long way to the downside in a hell of a short space of time. The S&P is down, 15-ish% over the last 3 sessions. In that sort of an environment, you could easily see a short-term tactical dead cat rebound
Well, not
on.
not only that, not just like rebounds, but just there's a lot of vacuum in the price action above, right? So
Yeah,
like,
absolutely.
markets love filling a vacuum, and but like you said, we've come off so much, like 15%. A 5% bounce, it would make sense. These
Yeah,
things do happen.
yeah.
But I think it's very careful. I think people will be very careful. That doesn't mean everything's all of a sudden okay. This is how just market structure works.
Yeah, 100%. And I think that's one thing I would just be. If you are participating this week, I'd be very careful about getting sucked into. Oh, the market is up 2% today. That means everything's fine. I
Yeah,
think we're in and I was saying this to someone last night. I can't remember who now. I think we're in an environment where it's not a case of if we were to sit here now and you go, where's the bottom? I can't tell you a number. I don't think the market is looking for a number or a
no,
percentage decline or, oh, we've reached the technical definition of a bear market, whatever. It's a case of the market craves a policy pivot and a policy response, whether that
yeah.
comes from the Fed, the White House, or another authority across the globe. That's the question that I think participants are going to be mulling
Yeah,
this
yeah.
week.
No, the market is not looking for your trend line that you drew 4 years ago.
No, not at all. Just two other things that are worth bearing in mind from a calendar perspective. And again, I don't think calendar events are going to matter too much this week,
No.
but we do have inflation figures due out of the United States on Thursday, CPI for March. Again, the data is very, very stale, but I think what we're talking about here is if the data's hotter than expected, headline is seen at spot 6 and core at 3 on an annual basis, incidentally. If the data is hotter than expected, then you're starting from a higher baseline from which the tariff induced price pressures will then hit the United States economy. So that's something worth bearing in mind. On a similar note, we do have sentiment data from the University of Michigan on Friday. And again, focus will be on the inflation expectations component of that survey. And lastly, in terms of fundamental catalysts, this week with absolutely perfect timing marks the start of first quarter earnings season on Wall
Yay.
Street. We are due to hear from JP Morgan, Wells Fargo, Morgan Stanley, and BlackRock, who report before the market open on Friday. Of course, the figures themselves, they're out of date. They're a little bit stale. They reflect, a period that frankly no longer exists. But nonetheless, the commentary around those earnings, particularly from the bank CEOs, it's been a hell of a long time since we heard from Jamie Dimon, for example, what they have to say about the state of the economy, about how they are seeing things evolve, and also about how they are viewing the Trump administration's policies will be very, very interesting indeed. But naturally, just to leave it on this one, focus will fall pretty much squarely on what's going on the trade front. And I think, it is clearly a very, very uncertain, very, very volatile environment. Again, that standard disclaimer, if you are listening to this back in a couple of hours, then things probably will have changed quite significantly. But
Yeah.
hopefully we've managed to provide some insight nonetheless.
Well, hopefully, and as you say, there's going to be headline risk for the foreseeable, which is why you should obviously be following PIQ's Twitter feed, because the PIQ elves are posting all the headlines that matter, and also you should be using the PIQ platform where you can see all the Twitter accounts plus all the Reuters news plus watch business TV. You can do it all. But Michael, Thank you very much for today. Obviously, if anyone is wanting to play some drinking games around the earnings commentary, I recommend a drink every time you hear the word tariff. You'll be shit faced very quickly, which is always a good thing. But Mr. Michael Brown, here's to a very good week ahead. If guys, listeners, if you are trading, try and keep it tight, stay out of trouble. Remember, you can always come back tomorrow. Do not do your ass. And we will see you tomorrow bright and early. See you later.
Indeed. Bye for now.